I'm Jane. Welcome to the Attract Capital webinar series. I'm here today with Attract Capital CEO and founder, David Barnett.
Hi, everybody.
Today we'll be discussing the value of structured equity. So before we get into this, can you define what structured equity is?
Sure, Jane. So structured equity is a flexible type of capital that sits in the capital stack between the debt and the equity in the middle. It's very similar to our favorite form of capital here at Attract Capital, mezzanine debt. It is non-controlling and it's largely minority preferred equity, and it's very versatile in its uses.
So if I'm a business owner, why should I consider structured equity?
Because structured equity gives you more capital to do transformational things. It gives you more money than you can get from your bank if you're looking to do something big and transformational.
That sounds exciting. So what kind of transformational things?
Well, in the business world, it would be something such as an acquisition, it would be growth capital, it would be a shareholder dividend, really any strategic investment, expansion of the organizational capacity, or if the shareholders have a liquidity need and they want to take some chips off the table. It is money that can go out of the company. Because if it funds a dividend, and a lot of banks are uncomfortable if the shareholder is taking money out of the company. If they're going to lend to the company, they want the money to stay in the business. So it's really acquisition, growth, or shareholder dividend.
Interesting. Can you tell us how this is similar to mezzanine debt?
Well, it sits in the same place in the capital stack as mezzanine debt, because mezzanine is below the bank but above the equity. Its returns are a bit higher than mezzanine. But like mezzanine, it's a much lower cost way of raising capital than bringing in a private equity investor, because structured equity is looking to be a low percentage shareholder in a company. They only want 10, 15, maybe 20% of a company. If you want to raise private equity really only is interested in 51% of the ownership of a company. So it's like mezzanine, but you don't have to pay the interest because the dividend basically is a payment in kind interest.
Thank you. So can you tell us the major difference between structured equity and private equity?
Sure. It's really one word, but it means those two, that switch between the structured and the private means a lot. So with structured equity, the business owner continues to control their business. With private equity, you lose control. And as I stated a little earlier, private equity wants 51% or more of the business. And really structured equity, the origin of structured equity was the fact that it was growth equity that came out of growth equity funds that came out of private equity funds, where they were investing in high growth industries. And people didn't want to sell their companies, but they wanted more capital to have a longer growth runway, is really where it came from. So the business owner, in the case of structured equity, as opposed to private equity, is empowered, which is a very important word for business owners, empowered with minority capital to strategically invest.
Thank you. Well, there you have it. Thank you for watching us on Attract Capital webinar series. We look forward to seeing you next time.